All right. Good morning, everyone.
Good morning,
Good morning,
Professor
Professor.
Hall.
Hi.
Good
Good
morning, Professor.
morning. Good morning,
Good morning.
Damien. Good
Good morning,
morning,
Professor.
Rosetto. Hi, Rosetta. Actually, um. All right. Um, I see like nine people in the collaborate session. Um, Let me just share my screen. Okay. There you go. You can see my screen now. Um, Well, it looks like it's just repeated reflection um, of the same screen because uh, I'm just the only thing that is being projected is uh, this Blackboard. But let me take you to a couple of so first of all. A couple of Blackboard features. Of course, you must be quite familiar with the Blackboard. Uh, well, by now, I mean we've been doing this for 2 years. So or actually, uh, this is 2 years, and this is the fifth semester of online class. Since the pandemic, the online modality started from spring of 2020. So this is like the fifth semester. So first of all, everyone should, you must have received all my emails, and it explains, exactly what to do as the standard procedure, right? So first thing you need to do is to report attendance in uh, the forum. You may have noticed that today's forum didn't appear until 9:30, and it just exactly it opened up at 9:30. So it's going to be like that every Saturday. The new forum for the scheduled date will open exactly at 9:30 a.m. You will need to sign in to report attendance within the first 30 minutes to be to validate it as present. And this is your physical proof of your attendance. Okay, and I see some of you are using like thumbnail or profile pictures. So I would also encourage you to use um, your profile pictures in the collaborate. And some may ask, how do I do that? Well, you see, you can see this gear icon. That's my settings, and you can press that, and I think you can, upload your profile picture there, right? So please try that out. Um, okay, and back there. Um, and you already at the beginning, right? Um, I mean, in the last, did I, in the last couple of days, within the last 3 days, I believe, um, I sent out like 4 or 5 emails. They were not necessarily sent out. I mean, I sent out in the right order, but they may not have been received by you necessarily in the right order. So some of the emails you should figure out which one comes first. But some people may have been confused because the emails were not received in correct order. But one thing you can easily understand is that the first of all the uh, the discussion board will open up exactly at 9:30 a.m. You need to report your attendance there for, physical proof of attendance. And then the collaborate session, I have them all. See, I have them all scheduled. They will just open up at a scheduled date, right? On the scheduled date at the scheduled time. And then let's take a look at the announcements. So yeah, I'm going to turn into a student mode just to make sure that you are seeing what I'm seeing. So of course, the first email that was sent out was the welcome message, and then, well, it wasn't just the welcome message, but basically the outline of how it's going to work, and also the class protocol, right? And so it's very important that it's very important that you make your attendance report, because each attendance is 0.33 points, and we have 15 sessions per semester. It will come down to 14 semesters actually, because we have spring break. So we'll come down to 14. Then you might wonder, so if it is not if it isn't 15, it's not gonna ideally add up to 5 points. That's fine. Instead, you can rack up participation points by answering the questions I ask. There will be ad hoc questions that I will be asking during the class, and then okay. The last name, first name order, right? That's important because in the class roster, and think about it, in every official document, the name follows. Your name follows the last name, first name order, right? That's the official how it is done in an official document. So to match with your roster, I mean, at least for me to easily match your name in the collaborate or in the to match your name in the discussion board with the name on the roster, you should follow last name, first name order. And then a couple of things about sending email. When you send email to me, please send it. Please use my Yahoo account, please, because I already explained this. The BMCC email, I got a barrage, literally tons of emails, junk mails every day. And it's not necessarily junk mails. There are some emails coming from the BMCC, coming from CUNY, and coming from the students. But all of them, somehow, I think it is, anything that is in the group email nature, anything that's in the group email nature is automatically going into the junk mail folder. And even though you are not sending a group email, but you are sending only, sending an email to me, but then you are part of the like Blackboard group. So somehow it is the BMCC mail server is automatically set to sort it as junk email. They all go to junk mail folder. Then I won't be able to discover them timely, right? So they won't be, and if your email is not discovered timely, then regularly periodically, those junk mails get purged. Okay, so if you want to, if you want your email to be discovered, then please send it to my Yahoo Mail, and do not compose new email every time. Just keep replying to your old emails. Okay, just keep replying to your old emails. That way, I can research the history, right? When you sent, if there was an issue and if there was an unresolved issue, I need to research. I need to research the history. When was the first email sent? Was it, replied to or not? Did I reply to it? Did I discover it on time? And did I reply to it timely? Everything, if it is all, in a single email string, right, or thread, right, it can be easily researched, right? So please do not compose a new email, okay? Just keep replying to your old emails. All righty, that's basically, what it is. And then let's go to, so currently what you can see is only the topic one, but that's, see, the grayed out ones, they are not yet visible to you, but they are all there. They will open up. See, it will become available February 16th. So they will be, they are all scheduled. Everything is on schedule. So everything is systematic. Everything is, methodical. Everything is, on schedule, right? So going into the first topic folder, these are PDF files or Excel files. So please download them. You will need them. You will need them to work with, as we go through the lecture. And currently, you can see only 10 videos, and which are all available for 1 week. And then the rest of them are also scheduled to open up on on the scheduled date, right? So, and when they become available, right? They will become available like 3 days before the scheduled class date. So February, our next class will be February 5, most likely, because from February, the release date, February 2 release date, we can tell, oh, that must be, yeah, February 5 is our next class. Okay, so always watch these videos, right? Study these videos before you come to class. Study them, right? I said, not just watch once. I mean, if you can afford to watch it as many times, try to watch it as many times as possible. I mean, studying means not just peruse. Studying doesn't mean excuse me. Studying means not just perusing. It means very meticulous analysis. You have to break it down this way. You have to break it up, break it down, and reorganize it, synthesize it, in many different ways. That's how you study. But of course, interesting thing is that I just use the word peruse, but even the word, because this is something people who learn English only by spoken language are really making mistakes, where people who only learn the language through spoken language commonly make mistake, because the true meaning of the word peruse, to peruse, means thoroughly, read, study thoroughly. But in colloquial usage, it means the opposite thing. People say peruse, as in spoken language, in a colloquial language, people use the word peruse to mean actually to skim through, just skimming through. That's so, but if you actually look up the meaning of the word, right? Look up, in the dictionary. It means, thoroughly studying, reading thoroughly, peruse. Because the word per means, thorough, right? That the Latin root. So, so what I meant was really, really peruse, right? But colloquial meaning, in a colloquial sense, people don't just peruse it, right? In a colloquial sense, but don't just skim. Don't just skim through it, right? Now, if possible, if you can afford to watch it many times, do it as many times as you want, as you can. Now, so what we're gonna start with. What we're gonna do is obvious. We're gonna start with, okay, I'm gonna have to open it all over again from. Oops. What folder is this? Downloads. Okay, this Excel. So when you download that file, right? I mean this file, right? That's the Excel file. You're gonna have that, and then this file is the PDF file. So let me open it from. Alrighty, so that's what it is. All right. So everyone already, since this is Finance 300, you all have taken Finance 100, right? Maybe it was just last semester, or maybe it was just, it was 3 semesters ago, or 4 semesters ago. You have all taken it. And if you have taken it, if you took it like long time ago, like 4 semesters ago, 3 semesters ago, maybe your memory is not fresh. But you will need to refresh your, you'll need to refresh your memory, right? So the first section of this bond characteristics, we're not going to go over that because that's clearly, relatively secondary, topic, right? You can always, come back to that, and you can always just read it up. There is nothing analytical about it. There is some analytical part about it, but not that much. Okay, we're gonna revisit basically from the section 1. We're gonna revisit the TIPS, Treasury inflation protected securities, and then and then invoice price, and flat price, clean price, or dirty price. That part we will revisit that, but otherwise, we're starting from section 2, because this is, we're just reviewing basically what we did in Finance 100, because that's what some of you may have already, some of you have forgotten, and that's what some of you need some, refresher, right? That's what some of you need refresher on. So first of all, let's go to, okay, let me open up now. Prior to the pandemic, before we began our the online modality, I didn't know about the whiteboard. Okay, one benefit of the Windows 10 and Windows 11, the later versions of Windows, whiteboard comes as a deep, so you can just scribble on it, and then you can just scribble on it and share it with other people. You may also notice that in the earlier those main lecture videos, right? The whiteboard I was using there, that was still early, in the early days. I didn't know this separate whiteboard provided that came with the Microsoft. I used whiteboard that came with the Blackboard, whiteboard that came with the Blackboard. That's which is very limited. And and at the time, it didn't allow I could scribble. There was a pen, but the pen function was very limited. So you see that I was almost writing on it with too much effort, because it wasn't easy to write on it. But now it's a lot easier to write on it still, but my handwriting on it's still very limiting, because it's not as precise as real handwriting. Now anyway, so we all know the formula, right, for bond pricing or bond valuation is basically consisting of two parts, right? Two parts. One is the annuity, present value of annuity, and the other one is the present value of just the single cash flow, right? And the present value of annuities and the present value of single cash flow. And the present value of annuities are basically coupon payments, right? Because bonds, pay coupon, and those coupons are annuities. So it consists of, and then at the end, at maturity, you receive the maturity value or face value, maturity value, or redemption value. Redemption value. Redemption means they redeem. The company that sold the bond redeems the bond by paying $1,000, right? Which is also called par value. Par. Par value. Now, FV here, FV, this can be, ambiguous because it can mean both, face value and future value. But, it doesn't matter. Why? Because in case of bond, future value and the face value are the same thing. Isn't that right? Because at maturity, which is in the future, right, you get the face value of 1,000. So it's the same thing. Now, here's one bonus question problem. So what is the face value of the bond? Anybody? Do you remember what's the face value of the bond?
1,000.
Say that again.
Is it 1,000?
Yeah, 1,000. Yeah. And who was this? Who is this? Who said
Sabrina.
that? Sabrina. Yeah. Okay, Sabrina. So today is what? 01. Today is 29. Yes, Sabrina. So Sabrina, you got 0.5 for that answer, Sabrina. Yeah. So yeah, the bonds have all the bonds. No, it's not all the bonds. But there are three types of bonds depending on who is the issuer, right? Anyone? Three types of bond depending on who's the issuer. So what are those three types of bonds? Can anyone tell me? Three types of bonds? I mean, depending on who issues the bond. Anyone? Now this is also this is a bonus point question. Yeah, Damien. Yeah, you can go ahead, Damien.
Professor, I'm thinking treasury bonds, mutual funds,
No,
well,
no mutual.
corporate bonds,
Mhm.
corporate bonds.
Yeah, you got 2 out of 3.
Okay, treasury, corporate, and
I think you said,
would
yeah. I think you
real
said,
estate
yeah. Say that again.
would real estate bonds be a bond? I'm not.
That's not.
Can't
That's
remember.
not. That's not the issuer,
Okay,
right?
right.
Depending on
Okay.
the issuers. Okay. It's treasury, corporate, and okay. Someone raised a hand. Someone. No. Before Sabrina, there was someone I heard. Yeah, Sabrina. Let me give someone else a chance. Alpha, I think, was it Alpha? Did Alpha raise
Yes,
hand?
yes, sir. Oh, was it
Yeah,
municipal?
municipal. Yes. So good. So I'm gonna give both of you. Who was that? Damien and Alpha. I'm gonna give you both 0.5. Okay, Alpha. Okay, uh, Alpha. You are the second person with the name. Okay, the only other person with the name that I know, it's not that I personally know, is a professor named Alpha Chan, who is actually a very renowned economist. He wrote the textbook. Alpha Chan. looking for his book, but where is it? There's something. Oh yeah, look it up. Uh, Fundamental Methods of Mathematical Economics. Fundamental Methods of Mathematical Economics
Got it.
from McGraw-Hill. That was long time ago. So maybe Alpha Chang is no longer alive. He may not be alive anymore. But no, I was the only other person. Maybe it's in, probably. Maybe it's been used probably since the 80s. Alpha Chang may not be around anymore. But anyway, three types of bonds, right? There are, depending on the issuer, right? So there's Treasury issued by Treasury, and corporate bonds issued by corporations, and municipal bonds by municipal authorities, right? Municipal agencies or municipal authorities. City and state governments, and city and state government agencies. And of these three types, only one is an exception. Only one has a different face value. Does anyone remember which one it is? And what's the face value of that? Yeah, Damien. Yeah, you can go ahead, Damien.
That would be the municipal bond, right?
Yeah, that's the municipal bond. And what's the face value of the municipal bond?
$100.
No.
Oh, I thought it was 100. Sorry.
No bond has $100 face value. Back in 1940s, even until like 1960s, the face value was $100, but not anymore since the 70s, 1970s. Anyone has? This was Finance 100, right? Damien, I'm going to give you another. Anyway, you didn't. You got the municipal bond, right? So I'm giving you another 0.5.
That's fine, Professor.
Huh?
That's fine. That's fine. I gotta tighten up. That's all. Thank you, sir.
Well, yeah. Good. Who said? Someone typed into. No. Shabir Ahmed, 1,000. No, 1,000 is 1,000 is in general 1,000 face value, but that's Treasury and corporate bond. Yeah, Sebastian, you can go ahead. Sebastian.
Oh, hi, Professor.
Yeah, hi.
The face value will be 100%.
Yeah, well, it's 100%. Yeah, that's right. But the percent, that's not the dollar value. I'm asking, what's the face value?
A face value is a number you can determine if it can be 100, 500, 200, 300, but it's like about a municipal bond will be 100%, and it will determine that according to its price, right?
Yeah, 100%. That's the 100% of the price face value. 100% of the face par value. That's what percentage bonds are quoted. In bond prices are quoted in percentage of the par value. So saying 100% is just the basic way. Basically how the bond prices are quoted, but that's not the dollar price. So the question was, what is the dollar price of the municipal bond? And the question was, the municipal bond was the only, as someone said, Irina, if you can, please, don't drop it into the chat box, because sometimes it can be, it may go undiscovered, it may go unnoticed. Irina, you got it right. Irina, 5K, yeah, 5,000. 5,000. You got it. You got it right, Irina. So Irina, you got a 0.5 point for that. All righty, good. So municipal bond is the only bond that doesn't have $1,000 face value. Um, it has the only bond that has $5,000 face value, right? So that's just a refresher, of the of Finance 100. Now, so basically, bond price. Of course, bond price is the present value of the bond, right? Because it's the sum of the present values. And annuity, present value of annuities is coupon payment, right? Basically, coupon payment. I'll just use, generic notation. Payment, that means, coupon payment over R minus payment over R. No. Over R times 1 plus R raised to N plus face value over 1 plus R raised to N. Okay? Now, some of you may have learned by a different formula, but it's not a different formula. It's actually just the same, a little, variant of the same formula. Okay, but this is, for if you learned from me, this is the one, and this is what also, this is our. This is the preferred variant, the preferred version by most, most, scholars and most schools. So here we all know this is the present value of annuity. This part is slightly, different depending on, what variant you have learned. But some of you may have learned. Let me open this. I'm just, opening up, my lecture note from Finance 100. So some people may have seen something like this. Which is, which looks more complicated. But think about it. It isn't really. Why? I mean, it's one variant of the same formula. But now think about it. First, if you factor out payment, right? If you factor out payment, the first term will become 1, right, over R, right? 1 over R. And then, so let me put it here. So suppose you factor out, this is a variant. everything will become 1 over r, right? And just, just the first term, not the second one, right? Ignore, for now, ignore the second one, right? Ignore the second term, right? We know something is here. And then we can take the common denominator and adjust the if you take the common denominator, right? We can have r. This is basically what I prefer. 1 plus r to the n, and you make adjustment to the numerator of the first term. Then this will become 1 plus r to the n, and nothing needs to be adjusted in the second term, right? This is normally what I do. If I want to transform this formula, this is normally what I do. But they take the different route. They simply take the different route. And then just transform it like, if you divide, basically, considering the second term, considering this term, considering this term as, not as a fraction, but, just as an integer, considering that as an integer, then, you bring it, they're trying to make it like the whole thing under R. The whole thing is under R, right? I mean, the denominator of the whole thing is R, right? This becomes, and then so it's not a different formula. It's just the variant of the same formula, but then this becomes more ugly, right? It becomes kind of ugly because you don't you have like a fraction. You have a fraction that's on like 3 levels, 3 layers. So this becomes ugly. So unnecessarily, that makes it look unnecessarily complicated, and also aesthetically not very clean, not very neat aesthetically. So anyway, I don't prefer this one. Not that it is wrong, I'm not crossing it out saying that this is wrong, but there's no need to use this variant, right? That's this is simple and straightforward. And also another reason I prefer this is because it is clearly showing the the effects separate, showing the separate effects from the annuities and the face value. As you can see from, like, this example, right? You see that most of the bond price is derived from the annuities, right? In this example, the present value of all its coupon payment is 809. And however, the present value of the par value 20 years later, right? That's only 306. So the majority of the bond price is derived from its coupon payment, not from the par value. And it is clearly broken up. It is clearly you might say, it's the same. That even if you use this, that the separate effect is still clear. Well, but this is basically how how most scholars, most academics use, especially in how do I know that? I saw in the past, years ago, I saw online lecture from MIT. They were doing, and the professor was, what was his name? Is one of the not John Campbell Law and McKinley Law. Was it Andrew Law or? Let me just check his name. It was one of the MIT professors. Yeah, Andrew Law. And he's using exactly this version, right? He was using exactly this version. So it's the same formula, but different variants. But if you ever, in Finance 100, if you ever learned this version, not because it is wrong, but it looks more complicated, right? And it is, aesthetically not very appealing, right? Yeah, someone may ask, someone may wonder, is there aesthetics to math? Yes, of course, there's aesthetics to math. Math is all about aesthetics. What mathematically is perfect is also aesthetically perfect. So anyway, what happened? Come on, don't give me this. Too small. Okay. So with that form, and another thing, some of you, the notation I use, B for intrinsic value, right? Intrinsic value of the bond. And if you have taken Finance 100 with me, you would remember that there are three different prices. There is intrinsic value, right? Intrinsic market price. Okay, let me put it. Intrinsic, and then book value, and then market price. Now, does anyone, and there's a reason why I put market price on top. I didn't throw it at random. Intrinsic value in the middle and book value at the bottom. Now, so first of all, market price is literally the price that you can see that's quoted in the market. In other words, every day, if you look at the stock price quotes, stock prices, just every day it fluctuates every day. And over the last week, almost slightly more than a week, the stock market lost, to some extent, it lost, even 20-25%, right? Especially Nasdaq lost almost 25%. Nasdaq lost, from its highest point, and the highest point was that was not that long ago. The highest point was, I believe it was like, sometime in December. But, and is that justified? And overall, all three indices, S&P 500, Nasdaq, and Dow Jones, on average, it lost at least something like 15%. But the question is then, is this justified? Is this loss justified? And some analysts say, well, because Fed is raising, interest rate. The FOMC, Federal Open Market Committee, which met like earlier this week, like Tuesday, Wednesday. Still, it wasn't unexpected. I mean, it's been expected since last quarter, that the Fed is going to raise, interest rate as early as March this year, and that was nothing new, no new information at all, right? From the last FOMC meeting, what they said after every FOMC meeting, Jerome Powell, the Fed chairman or chairperson, holds the press conference, and that that's called Fed's guidance, right? Federal Reserve's guidance. They do that after there are 8 FOMC meetings throughout the year, and after every open market committee meeting, they hold press conference. So there are 8 guidances that are being released, and this was already expected. I mean, from the previous FOMC meeting. In other words, from the FOMC meeting in December, or was it December or November? The last FOMC meeting of 2021, they still said the same thing. So nothing was unexpected, and it was just surprising. At least it was surprising that that the Fed still, Jerome Powell said that they are going to hold the Fed funds rate, the benchmark rate, at 0 to 0.25% until March. So this was actually, unexpected, because at least I anticipated that they something even not drastic by drastic measure, that the rate will go up even by 0.25%. But Fed still maintained that they are gonna wait until March and still keep holding it until at 0 to 0.25%. This was a I think this was a reaction to hysterical reaction in the stock market, because stock market right before the FOMC meeting just plummeted, took a nosedive. But then think about it. You all know after FOMC meeting, then Apple and Tesla's results earnings report came out. Everyone knows, the first month of every quarter is called earnings season. That means they are reporting their earnings from the previous quarter, right? When you say earnings season, it cannot mean it's the earnings from the first quarter, because first quarter hasn't ended. When they say earnings season, they are releasing the earnings data, report from the previous quarter, right? The quarter must end first, right? And then they can compile the data, and then they can release the data, right? So it comes only after the quarter is over, right? So Apple and Tesla's report came out after FOMC meeting. It's not like they timed it, but it just happened that way. And they did very solid earnings growth. They had very solid earnings growth, right? With such a solid earnings growth, of course, you can say market didn't know. Market didn't know, so Apple and Tesla's price fell anyway, because market didn't have any actual earnings, information, earnings report from the fourth quarter. Then, but it wasn't, even if the earnings report didn't come out, right, until after the Fed meeting, right? Federal Reserve open FOMC meeting. It's irrational. Think about it. It's irrational that the market reacted that way to Tesla and Apple. Of course, although Tesla's price is still has bubbled. Tesla is still overpriced, and I'm not a big fan of Tesla, in the sense that that Tesla's price is still overpriced. But that doesn't mean I'm not I'm not a big fan of Tesla as a electric vehicle. I like Tesla, in the sense that it is a green, environmentally friendly, green energy, and green technology, green engineering, and the way of the future. But Tesla's price I don't like because it is, still overpriced. Apple, I'm not a big fan of Apple product, but I'm a big fan of Apple as the company, as for its, growth and, for its, stock price. So, and if anybody, an analyst, not an ordinary Joe, not an ordinary Joe in the stock market, but an analyst, at least an analyst would know, even if the earnings data wasn't released, looking at the past, performance and past data, Apple and Tesla should not fall like that. It shouldn't be justified, right? But that's what the market price is. Market price is basically a herd swayed by herd mentality. It's a herd. It's a herd action. Like so market price is basically irrational. Market price is irrational, right? Book value is solid. It's solid because it's based on the actual data. But the actual data is always past. Think about it. We cannot have the most current data we have is always past because Apple and Tesla released their fourth quarter earnings report. But then that's fourth quarter as of December 31st, right? As of December 31st, 2021. Now we are already 1 month into 2022. So no matter how current any book data is, financial book data means financial statements data. No matter how current they are always past. So once we have moved 1 month away from that past, that although it is solid data, it's always past data. So then the intrinsic value is the value that is based on future cash flow, right? Which is calculated by discounted cash flow model. And this is rational price, rational. So it's also called, fair value. Intrinsic value is also called fair value and rational price, as well as rational price. So most of the times during the rally, if the market was even until like even until the second week, first week, I mean, before the market crashed, not crashed, but market lost like 15%. Even before that point, market was just, rallying like, crazy. I mean, that was irrational because market was overheated. The market price, when the market is in uptrend, market price is always above book value and it's above intrinsic value. But when the market is showing downtrend, like recently, then the market price would be below intrinsic value. It may not be below book value, but it will be below intrinsic value. If it is really below book value, then it's really crazy because that means market is really under pricing the asset, and that means this is the time. If it is below intrinsic value, or even below book value, it's the time to buy. You're buying it really cheap, cheaper than what it is really worth. Oh, I think it's 10:38. Normally I would take a break at 10:30. We are like 10 minutes past, almost 8 minutes past the time to take a break. But let's take a 10-minute break. This is a good time to take a break. Let's take a 10-minute break and come back at like 10:50. Okay, 10:50, give or take 2 minutes. All right, all right. So All right, all right. So we're back. We're back. So I was talking about the difference between the market price, intrinsic value, and book value, right? And here's the thing. I mean, you might wonder why uh, why is it price for market price, and why is it value for intrinsic value and book value? Um, Now think about it. There's a good reason that market price is called market price. It's not called market value. Why? Uh, because value is something. Value is the true value. We don't say uh, when we say value for money, right? Um, uh, that means we're getting more for the price. In other words, um, but the price is whatever is determined by the demand and supply situation in the market, right? Uh, in other words, uh, price can be outrageous. Price can be irrational. I mean, for example, uh, if uh, if a bottle of Coke is $5, if a bottle of Coke is $5, um, nobody would nobody would say nobody would just take it. Nobody would say that's a fair price. No, it cannot be fair price because why? Because it's true value, intrinsic value. Think about the intrinsic value. I mean, intrinsic value of Coke cannot be something like I mean, it's something to quench our thirst, right? And if a 16-ounce bottle is $5 or $10, uh, everybody would say it's crazy. I mean, also think about it. Gas, the intrinsic value of the gas. I mean, gas is going for about how much is it going for in New York? 380 something, 380 or per gallon, right? In California, it would be 480 in California. California, they have really, a priciest, gas price. But then if the price really represents its true value, how can it be, you know, how can there be a dollar difference between the East Coast and the West Coast, right? And everybody understands why. Because it's because of demand and supply. Of course, you might say, in the East Coast, uh, in New York City, the demand for gas uh, is as no less than no less than Los Angeles or San Francisco. Yeah, the demand for gas still, you can say uh, we'll have to actually look at the actual data demand. But look, at least we know in the East Coast, in New York City, we have more well-developed mass transit, and more people use, the percentage of people that use mass transit would be greater than the percentage of people using mass transit in Los Angeles or, state of California. I mean, their dependency on driving is greater. But anyway, the point is there is intrinsic value to everything. And what's the intrinsic value? For example, even $100 bill, what is the intrinsic value of $100 bill? Huh? Can anybody tell me what is the intrinsic value of a $100 bill? Hmm? Intrinsic value? Now think about it. Fiat $100 bill, dollar bill is a fiat money. Fiat money means it's something we put trust in, right? So of course, the Federal Reserve is backing it up. And then you might wonder, who's backing up the Federal Reserve? Oh, well, then, if you go down the line, the member banks that constitute the, Federal Reserve. But who backs up the member banks then? Now, think about it. It all boils down to the capacity of the U.S. economy, production capacity of the U.S. economy, right? The production capacity of the U.S. economy is backing up our belief or trust in the fiat money. But then the intrinsic value, so $100 bill can buy as much as $100, what $100 can, $100 worth of goods and services, and that's not the intrinsic value of $100 bill. It's the it's purchasing power of $100 bill, which is backed up by the eventually backed up by the production capacity of the U.S. economy. But then, what's the intrinsic value? Intrinsic value is what's the value of the paper and the ink, printing ink, right? Think about it. The intrinsic value of paper money is nothing but the value of what it constitutes, what it's made of, right? So it's just a piece of paper and printing ink. What would be the dollar value of that? Not more than probably, not more than $1 at most. I mean, that would include that the silver line. What's that called? There is a silver small sliver of silver line that it's not really silver, but that is embedded in the dollar bill to prevent counterfeiting, right? So the fiat money totally has very low intrinsic value, right? In the old days, when the gold was used as currency, then gold had intrinsic value. Gold had intrinsic value. So intrinsic value is derived from, but then what is the intrinsic value? So if you have a house, the house has an intrinsic value. Why? Because at least the building material that went into it, the value of the building material, right? The value of the appliances that went into it, the value of the decor, right? Interior decor that went into it, value of the furniture, and all these things. That's the intrinsic value, right? The price, but the price would be above the intrinsic value, sometimes below the intrinsic value, right? If the market crash, during the prior to 2008 financial crisis, 2007, there was a housing market crisis. Housing market crashed, and the homes that were put on sale in the resale market, they were slashed by more than 50%. I was below even its intrinsic value, right? So the market, That's the reason why we don't call it market value. That's the reason why market price is called market price. The others are called value. Okay, and then intrinsic value is the one. Book value has a once again, book value has its own shortcomings because book value is always based on the past data. No matter how current it is, it's always past, right? But intrinsic value is based on the future cash flow, expected future cash flow. Again, this is the important thing. In finance, think about it. All the assets, all the financial assets, the price of all the financial assets is basically the present value of all its future cash flows. Okay, future, it's actually free cash flow, and of course, future free cash flow. So in other words, this is the result of the discounted cash flow model. Discounted cash flow. And it's only rational because bonds, think about it, bonds pay coupons, right? And the bonds pay coupons, and coupons are fixed, and it's an obligation. It's a legal obligation. Anybody who borrows money have to pay interest. It's a legal obligation. There is a legal sanction. There's a legal punitive action if you don't live up to that, right? So in case of bond, that future cash flow is certain, expected, and certain, right? There will be coupon payments every 6 months, and then finally, at the end, you will get the par value or the maturity value or the face value. Of course, you might, some people may say, what if the company goes bankrupt? I've been telling you, in Finance 100, I've been telling you already, yeah, company can go bankrupt, but that's why there is the bond credit rating, right? That's why there is credit rating. And the bond, so that's why you don't invest in the bonds that have below BBB ratings. Only BBB and above are investment grade. So as long as you don't make such a risky investment, but invest only in the bonds with BBB or above credit rating, then you don't have any. You have relatively very low risk that they will default. Okay, so based on that, that's why come on. That's why B is the symbol for intrinsic value of the bond, intrinsic value or fair value or rational value, rational price, rational. Okay, and this is my notation, and you will see in my notation, right? You will see I make distinctions between the intrinsic value and market price. The market price, the symbol for market price will be P sub B. It means price of bond. Okay, so please make that distinction. There's a difference between market price and intrinsic value. And think about it. It's all about the whole exercise is about whether the whole idea behind studying this is to find whether what kind of relationship there is between the intrinsic value and the market price. right? If the market price is below the intrinsic value, I mean, there are three possibilities, right? Market price can be greater than intrinsic value, or less than intrinsic value, or equal, right? Or equal. And of course, it's rare, but the market price and if it can happen, it's rare, but it can happen. Market price being equal to the intrinsic value, it's rare, but it can happen. That's when it's when that asset, when that particular bond is in equilibrium. When it's in equilibrium, then the two will have to be the same. But equilibrium is a very transient phenomenon. It doesn't last long. It's very transient. It's there and then it's gone. Right? Something that and most of the times, either market price would be greater or less than. Especially this will be more pronounced in the stocks. In bond, this is less pronounced. They will be generally, they are in line, because in case of bond, the variance of the price, the variance in price is very narrow. The variance is narrow. Why? Because in case of bond, the price abnormality, or the price deviating from the intrinsic value is rare. Why? Because there is very little ad hoc factor. There is very little, in other words, there is very little unknown variable. In case of bond, unknown or ad hoc factors or variables unknown variables or ad hoc factors are very little, very low, very little. So most of the times, market price would be well aligned with the intrinsic value. But if ever, because this is going to be more, we're not using this reasoning for only bond, but this reasoning is more intensively used in case of stocks, right? We have to keep this in mind. Is the market price greater than the intrinsic value? The market price less than the intrinsic value? If the market price is less than the intrinsic value, then that means there's going to be, this is the buy target, and vice versa. If the market price is greater than the intrinsic value, then it's the sell target, right? It's the sell target. So why? Because there's going to be a correction. Correction means usually, sooner or later, there will be a correction. Correction usually means, a downward correction. In the stocks, correction means downward correction. But there's also upward correction as well. If the market price is below intrinsic value, then it's, market is underpricing or undervaluing the asset, right? But then, the price will, the correction will happen upward, right? All right. So with that in mind, right? Any questions so far? Any questions? Any questions so far? Yeah, Louis.
Yes,
Go ahead, Louis.
For the bond exercise 1,
Mhm.
or bond exercise 0, I should say, it's
Mhm.
titled. It says page 175, 9.2, but I couldn't.
Ignore that. Ignore that. I'm
Okay.
sorry. the page number, ignore that, because that was the example I took from Finance 100. So
Oh, okay.
ignore
Yeah.
the page number.
And then also
Actually,
another question I had is what does C represent? Because the percent of the
oh,
rate.
that's coupon rate.
Oh, okay. I see.
Coupon rate. Mhm. All right. And
All right.
you might also wonder, why are the rows, row numbers? You would see something's weird about the row numbers. Why isn't it starting from row number 1 and then suddenly making a jump from 8 to 17, and then making a jump from 22 to 30? Well, that means there are rows in between, but I deliberately collapse those rows so that the examples in between won't show. I mean, if it is necessary, I will show it. If it is not necessary, uh, better not, better not to, um, have it there. Okay. All right. So with that in mind, so let's go to the bond valuation exercise, right? But let me make sure. Okay. Okay. So let's go to that exercise. So if you have this file in front of you, right? Everyone has this file in front of you, right? Please confirm. Do you have this file in front of you?
Yes, sir.
Yes.
Okay.
Uh,
Okay.
I haven't been able to download it yet, but I'll check on it later, sir.
Oh, you need to download it now because we're gonna work on this, and it's critical. It's imperative that you work on this together, right? Um, try to download it. I mean, if you can't for some reason, if your if your internet is slow or your connectivity is not good, then there's nothing you can do. But if possible, try to download it and have it in front of you. I'll have to assume that everyone has it, and let's get started, right? So first of all, this is like a review of what we did in 100. So this is face value, right? As well as future value, because in case of bond, as I said, future value is the same thing as face value. This is coupon rate, 7%. So payment is, and all the bonds pay coupon semi-annually, right? So the compounding frequency is 2, and M means compounding frequency per year. Of course, some bonds can pay interest only annually, but that's rare. They are all, basically all bonds are on semi-annual cycle. And of course, there are bonds that don't, zero coupon bonds that don't pay interest. But as long as they pay interest, they are semi-annual. So coupon payment will be $35, right? That's quite obvious. That's quite obvious because 7% of 7% of 1,000 is $70 divided by 2, right? 35. And then time to maturity, 20 years. 20 years left. Then actual number of compounding is 40, right? N. Actual number of compounding is 40. Now, APR, sometimes this will be, this is wrong. I'm actually, I'm gonna fix it later. So they are switched in a way. Okay, let me fix it now. They were switched. So APR is also in bond. This is also called yield to maturity, and yield to maturity is the okay. Yield to maturity is the basically the discount rate. The discount rate. So half your rate would be 3%, right? Again, you may have noticed that nothing is manually entered. I mean, except for the initial data, nothing is. So initial data, 1,000 face value, 7% coupon rate, 20 years. That's the initial data. Those are the initial data points. Other than the initial data points, nothing is manually entered. So, but that's how it should be. You should never enter anything manually, because if other than the initial input data, you should never enter anything manually, because if you do that, then you will end up with a rounding error. Inevitably, there will be rounding error. So this is actually bond price, right? We're trying to find the present value of the bond, so that's bond price. Intrinsic value of the bond, intrinsic value. And to do that, we know we're going to use the present value of annuity and present value of single cash flow. So first of all, present value of annuity. So payment over R minus payment over open parenthesis R times 1 plus R raised to N, right? And plus $1,000 divided by, oh, I put twice, plus twice, but I'm going to fix it later. And plus R raised to N. Doesn't matter. Okay, so everyone is good. Everyone is good with this. Maybe I'm gonna have to probably. I'm gonna do that later. Everyone got this right? And let's hit enter. I will assume that you got it right. Hit enter. Something's not. Oh, I see. I see. I should have closed this. I forgot to close that. That was instead of closing the parenthesis, I accidentally hit plus there. So hit enter. We got this. 1,115.57. Everyone got the result?
Yes.
Okay,
I actually
one
got
person.
the same result using the PV function built into Excel.
No, yeah, well, you can do that too, but I would prefer that you rather not use Excel's built-in function, because if you use Excel's built-in function, it will be it's like if something goes wrong with, of course it will rarely go wrong, but if something goes wrong, you can't fix it. If something goes wrong with that black box, right? Because Excel's built-in function is like a black box. So if something goes wrong, you cannot open it up and fix it. But if you use a formula, if anything wrong, you can fix it. Or if it is a problem with the input data, of course you can, it doesn't matter whether you use Excel's built-in function or not. You can, you can fix the input data, and you can still solve the problem. One thing you have to remember, if you use Excel's built-in function, right? You have to distinguish between cash inflow and cash outflow. So you have to make one thing a negative. Always cash outflow, it's best to make cash outflow negative. So who used Excel's built-in function? Who used Excel's built-in function? Louis, yes.
Yeah.
Yeah, good. Okay, so when you used it, did you make distinction between cash inflow and cash outflow?
No, I didn't.
If you didn't, then how could you? If you didn't, how could you arrive at the same result? I mean, if you use built-in function, let's just present value. It's present value, right? You go to financial category and go to present value. Hit OK and give it what it's asking for. Rate means, the discount rate, and periods, and payment. But you gotta give this, you enter payment like it is, then it's not gonna work. I'll put it like that and see what's gonna happen, and then you enter future value, and then what do you get? You get this as negative. You get this as negative. Now, I mean, there's nothing wrong with this, because there's nothing wrong. This is right. This is correct. Why? This means, this is your cash outflow. This is your cash outflow. So that means, think about it. If you are buying this bond, you'll have to pay $1,115.57. So that's what you pay. So that goes out of your pocket. Goes out of your pocket. So it's your cash outflow, and that's why it's gonna. That's why it's gonna come out as negative. I mean, the red font, or minus sign, and red font and the minus sign and the parentheses, all of them, or rather it should be or red font, parenthesis, or minus sign, all of them represent negative number or cash outflow. So it's cash outflow, so nothing's wrong. It's correct. But without constantly being cognizant that this means cash outflow, you may get misled. You may get mistakenly, you may construe it as negative number. No, it's not negative number. It simply means, cash outflow from you. But then once you pay this price and buy the bond, for the next 20 years, you'll receive $35 every semester, right? Every semester for the next 20 years. And at the end, you will receive $1,000. So they are all cash inflows. So yeah, it comes out as this. Okay, comes out as this. Okay, so there's nothing wrong with this. But sometimes making a distinction between unless you make a distinction between cash inflow, cash outflow, and that function doesn't work, especially if, in this case, it was only the bond price, but if it was a question about R, the rate, or question about N, right? It's going to be without making distinction between cash inflow and cash outflow. It's not going to work, okay? So that's why I want you to stick to the formula, right? It's also like, the too much dependence on GPS. These days, people don't have mental map in their mind. Before driving a long distance, you would have a mental map normally, but some people just turn on the GPS and just follow the GPS prompt. Sometimes the GPS makes a mistake, or sometimes it doesn't prompt you timely. It doesn't prompt you timely. Most of the times I get this a lot. Railroad crossing ahead. Actually, that prompt comes out when I'm actually crossing the railroad. So it's delayed, or sometimes I should have already made a right turn, but after passing the intersection, then the prompt comes, make a right at the intersection. So look, that's what happens if you depend too much on the GPS. You miss the turn and then you gotta go around, and right? So you need to have a mental map, right? So that sometimes, even if you have a mental map, sometimes, if you are so dependent on the GPS, then you have this inner struggle, because you should make a right turn at the next intersection, but the GPS isn't telling you, GPS isn't prompting you. Even you're near, you're almost there. This is the time you have to make the right turn. But if you delay anymore, you are missing that turn. But still, the GPS isn't prompting you. You have this inner struggle. Do I have to make a right turn? Why isn't it why isn't it still telling me? And then you miss the turn. So do not depend on Excel's built-in function. Okay. Now, next, this is another way. This is another way we can do this. But we are going to use Excel's price function. But then to use Excel's price function, we must put all the prices in percentage terms, right? In percentage. And to use this formula, price formula, you have to have settlement date, and maturity date. Settlement and maturity. Okay, you have to have also 2 additional columns for, right? And to do that, so in this example, face value is not $1,000, but it is $1,000. You say, oh, you might be saying, why? It says 100. No, this means 100%. 100%. I just kept dollar symbol to to have the consistently dollar symbols for the dollar price, but this is 100% of $1,000. Makes sense? And the coupon rate is 5.5. So the coupon payment would be $27.50. Okay, this is not $2.75, right? And then the time left is 15 years. So actual number of compounding, 30. Okay, and then this is the yield to maturity, which is the discount rate. So half your rate is, of course, that's not a difficult thing. That divide yield to maturity divided by half, right? Half of that. And I used, a little different notation here, IRR, internal rate of return. I'm going to get to that later. So the price, you're buying this bond. Look, you don't actually have to buy this bond, but this is when you are evaluating this bond. Okay, time zero, November 15th, 2011. This is when you are evaluating this bond. So you're pretending as if you're buying the bond. You don't have to buy the bond actually, but just for the purpose of evaluating, you use this date as the settlement. Settlement means, you're buying the bond. And for every transaction, there must be a settlement. That's what is meant by settlement. Okay, maturity. Yeah, if it is 15 years later, right? You add E19, which is 15, but all the calendar dates on Excel, all the calendar dates on Excel are based on the days, right? So you have to convert it. 15 if you just add 15, it's gonna just add 15 days, not 15 years. So that's why I had to multiply it by 365. Then it ends up with 11/11/2026. Okay, with that in mind, we'll use price function. So go to function, select financial, price, and once again, I would recommend, I would just recommend doing this using the formula. But if you want to use, if you have, settlement date, maturity date, we'll have to use price function. Settlement date is this, so you click it in. Maturity, you click it in. And then rate. This rate means, interesting thing is this rate means what? This rate means coupon rate. That rate means coupon rate. So coupon rate. And yield, this is the yield. Okay, you don't enter half year rate, but just enter the whole year rate, yield. Redemption value is, of course, 1,000, which is entered as 100. Now frequency 2. Frequency is 2, right? Because this is important, because if you don't enter this, only with the frequency, the Excel will divide this by 2 and use this, half year rate. So now it shows something here. If you hit OK, comes out $90.51. First of all, is this $90.51? Anyone? Everybody?
No.
No, Professor.
No. Doesn't mean $90.51. Yeah, thank you. At least 2 people responded. This means actually everything is expressed as percentage of the par value. So this means 90%, 90.51% of 1,000. So its actual dollar value is 905 and 10 cents. 905 and 10 cents. Okay. Is it 10 cents exactly? Let's
It's
try
12 cents.
Yeah. Increased decimal. Yeah, you will see it's 12 cents. Okay. So, 905, 10, that's close enough. So this is how you use the price function. But then the reason I prefer using the formula is that you have to put everything in. To use this function, you have to put everything in the percentage, right? And then it's not a difficult thing, but it doesn't look very nice. I mean, $90.51. I mean, sometimes it can give some confusion. I mean, you wouldn't get confused, but a novice will get confused. All right. So it's again 11:38. So it's about the right time to take a break. So let's take a 10-minute break and come back at like 11:50. Okay. Let's come back 11:50. I'll leave this at. I'll leave this like this. All right, we're back. We're back. So let's think about now yield to maturity. I mean, um, in any discounted cash flow model, right? Uh, and I said yield to maturity is the discount rate of the bond, but basically discount rate is of a crucial factor in any asset pricing model because all asset pricing models are basically discounted cash flow model, right? Remember, all all asset pricing models are basically discounted cash flow model. And then inevitably, the discount rate is very important. But why in a bond, why in a bond the discount rate is yield? I mean, yield is basically annualized return. Yield is basically the annualized return. Right? Yield is annualized return. So yield is not only the term for bond only, but also for stock or for any asset. The yield is a very generic concept. It's a annualized return. But in case of bond, yield to maturity is yield to maturity is they this is something we already did in Finance 100. They call it long-term yield, long-term return, right? Long-term return. If you're holding it to maturity, I mean, even if you don't hold it to maturity, I mean, if you just bought the bond today with 20 years left to maturity, and even if you sell it 5 years later, right? Whether you have already planned to sell it 5 years later or not, doesn't matter. I mean, you may or may not sell 5 years later, but no matter, but if you don't have a specific plan to sell it at some point, how do you know how long you're going to hold it? Basically, you will assume that the annualized return, based on the assumption that the bond goes on, until maturity, right? The annualized return would have to be something like this. That's why they call it long-term yield, of course, versus, if yield to maturity is long-term yield, short-term yield is current yield. But, I'm not going to repeat this because that's something also discussed already in Finance 100. Now, but the yield to maturity is used as the discount rate, right? Of course, you'll need to discount any asset by its required return. And in case of stock, we find the required return using CAPM. In case of bond, the long-term yield is basically the required return. So interesting thing is, and I said this also in Finance 100, I really, emphasized it so many times that this is the way it is worded. In other words, in no bond pricing, bond valuation problem, there's no such verbiage as use this as discount rate. Okay? none of the bond problems say directly, this is the discount rate. Use this as the discount rate. No, they never say that. So then how is it worded? It's worded in one of the three ways. One, the bond is price to yield. The bond is price to yield X%. Okay. Second, comparable bonds or similar bonds yield or pay X%, right? And three, prevailing prevailing rate is X%. Okay, so that's how it is worded. Largely three ways it is worded. The bond is price to yield X%. The comparable bonds or similar bonds are paying X%. Or prevailing market rate is X%. And they all mean, basically, this is the discount rate. Use this as the discount rate. But no problems actually tell you straightforward, use this as the discount rate. So if it is, the wording is very interesting. A bond is price to yield 6%. What does that mean? Currently, the bond price is something. That means, think about it. If it says bond is price to yield X%, what that means is currently the price of this bond, that means the market price. The market price of the bond, is something, right? Market price of the bond is something, so that the yield would be, annualized return will be X%. So if you think about it, the perspective, the point of view is, there are two things, if we don't know the intrinsic value, if we don't know the price of the bond, so we find the intrinsic value. In that case, we know what to use as the discount rate. Okay? But here, if it is worded this way, the bond is price to yield X%, that means this price is what you see in the market, right? So that depending on that price, based on that price, it gives you X%. In other words, this is not that means this X%, of course, in this case, is given, they gave you already, but then this can change, right? Depending on what market price is, right? That's what it means. So, let me put this, okay. So if this is how this formula is what I do to find the bond price, right? then if I write it like this, if I put it differently, so let's see if I put it like okay. If I put it like this, you might, what's the difference? Some of you might wonder, really, isn't it the same formula? Yes, it's the same formula with two exceptions. What are those exceptions? Well, I used, the notation has changed. Instead of R, I used, Y here. And then this thing is P sub B, right? P subscript B. So you all know P subscript B is the market price. Market price. That means, this is the price that you see quoted in the news media, right? Financial news media, or print media or online media. It doesn't matter, but this is the price that is quoted price, market price or quoted price. So it's not something we solve for. This one is something we solve for, right? B is what we solve for. But this one is not what we solve for. This is given. And then what is the unknown here? This is the unknown. Right? If I write it this way, that means this market price is given. Payment is already known, because as long as coupon rate is known, what coupon payment it will be, it's known, and time is known, face value is known, everything else is known. What's the unknown? If left-hand side of the equation is known, then something in the right-hand side is the unknown, and that unknown is that y. Okay, so in other words, we need to find, if the left-hand side value is known, then we need to find the right-hand side y value, and there can be only one y value. One unique single unique y value that will satisfy this equation, right, this equal sign. There cannot be multiple values. There can be only one single unique y value. And then that's why it is. So if you find that, then that's why they say the bond is price to yield. Right? X percent. The bond is price to yield X percent. Okay, the bond is price to yield X percent. So that is what yield is, yield to maturity. So let me go back to so here, and we all understand price. There is, of course, inverse relationship between the price and the discount rate, right? There's no question about it. Okay, here, so often worded as bond is price to yield X percent, or similar bonds pay X percent, right? because there's an inverse relationship between the discount rate and the result of the fraction, right? Result of the fraction, because by mathematical structure, by mathematical construct, the result of the fraction is inversely related with the denominator, right? Does that make sense? So as yield goes up, the price will go. In other words, discount rate goes up. Go back to the formula. It's obvious. If this goes up, this will have to go down, right? And then if this goes down, this will have to go up, right? Or, I mean, since this is actually PB is given, maybe, I should have done it here. If this goes up, this will have to go down. And if this goes down, this will have to go up. This will have to go up, because that's just simply by the mathematical construct, right? Simply by the mathematical construct. There's an inverse relationship between yield and the price. So here, we can find yield. I mean, we can find R using the rate function. Using the rate function, we need to use Excel's built-in function for that. But here, to find yield to maturity, we'll have to, okay, nothing's given here. Why? If nothing's given here, it's going to be difficult to I-15. What is I-15? So I think I-15 we need. Okay, so you can double click, putting the cursor here on top of the row number, and double click, and it will expand the rows. And there was a clearly, obviously, there were some other problems. So depending on what it is in row 15. So to row 15, let me fully expand. All right. So wonder what was. Okay, here, look, we can find, first of all, I think the color coding was, wrong. Okay, there is a convention in color. I mean, the primary solution is always, the yellow. Secondary solution, like light olive green or drab or whatever you call it. So here, in this problem, look at row 12. We'll have to do row 12 first, then. Now this time, the price of the bond is given. So this is like P sub B. subscript. P sub B. So if the price is given, and the question is, what's the discount rate? So we'll need to find the half year rate because everything is on a half year cycle. So here, we'll have to use rate function. Go to Excel, scroll down until you find rate. Give it what it's asking for, N, payment, present value. This is the present value, which is in, no, you can't enter, yeah, I-12, right? I-12, you can barely click it in. But you know, if you cannot click it in, just enter I-12 manually. And then, so I-12 present value is already in negative, so it works. If it is not negative, it's not going to work, right? And I've been telling you, it means the cash outflow, and the all financial calculators must make distinction between cash inflow and cash outflow, otherwise it's not going to work. And then a future value. No need for type. Type means, you know, either no need for the ordinary annuity or annuity due, but you know, all bonds are ordinary annuities. Hit OK. Comes to 2.36. So that's the half year rate, actually. That's half year rate. And internal rate of return is the rate that makes the, so this is what I was, this is what I was talking about. If you are solving for, if the price of the bond is given, right? This is known because this quoted price is known. Price of the bond is known, right? This is known. Everything else is known. The only unknown is y, and there's only one single unique value, single unique value, and this single unique discount rate will make the right-hand side of the equation equal to the left-hand side, right? And there's only one value that can make the right-hand side equal to the left-hand side. Only one single discount rate that makes the right-hand side equal to the left-hand side. That's called internal rate of return. That's called internal rate of return. Okay? That's the mathematical name for it, internal rate of return. That's why I put, you know, it there. So here, but that's the half year rate. To turn it into a full year rate, then what do you need to do? All you need to do is simply multiply that by 2. Right? Multiply that by compounding frequency, which is 2, and you get 4.73. That's the yield. Okay, that's the yield to maturity. So to do this example, row 22, it uses, you know, currently I see that it uses I-15 for that. So to have I-15 there, I think to have I-15 there, we need some yield to maturity here, which may be this one. But you know, let me find out which one was the yield to maturity I used for this example. But you know, so we will have to do that. we'll have to do that. We'll have to do this example next time because it's 12:15. It's already 12:16. So the class is over, technically over. And just to make sure, any questions so far? Any questions?
Professor Hahn, good afternoon. This is Ebony. How you doing?
Yeah, I'm good. How are you, Ebony?
I'm okay. I just have a quick question. It's not to this class. I have you on Monday, but I don't see you on Blackboard. Did you load the the class up to Blackboard yet? I received the email for FNB.
Oh, you mean
FNB
230? Yes, yes, it is. It's visible. It's already. It's
but
Monday,
I didn't
Monday
see it. That's why I was concerned.
let me just make sure. Let me make
Okay.
sure here. Let's see. I saw Damien's hand, so I know Damien. You're next in line if you have any questions.
Thank you.
You're welcome. 230. Oh, why? Okay, I thought I made it available already.
No.
So it should be visible to you. Already.
Now?
It should be visible to you. Yeah. I already made it.
No, but I don't see it on, I don't see it on Blackboard. That's why I was concerned.
It is on now. I already
Okay, now I see it. Now I see it. Now I see it. Yep. Okay,
Yeah.
so, and also the next question, do we come down to Fitterman? We go in
Yeah, you come to Fitterman.
Okay.
I don't know how much longer this weather will last. I mean, if Monday we still have this weather, maybe there will be CUNY alert.
Right.
Right? There was something on CUNY alert. But unless the weather persists, or there is the city hasn't recovered its mass transit, then we might have we might go online. Okay. It's on.
No, the reason why I'm asking is because the email that you sent last week, it was saying the sign-in options, like go to discussion board and put your name. So I was kind of confused.
Yeah. You will still need to do that. Even in-person class, you will still need to do that, because that way you will have physical proof of your attendance.
Okay, so I'll see you Monday. Enjoy your weekend. Thank you so much.
All right, you too.
Okay,
you
bye-bye.
Too. All right, bye. Take care now. Damien, yes. What's your question, Damien?
Yeah, Professor. I still have the book from last semester. Is that the book that we're going to be using for this semester? That is that $90 book?
Yeah. Were you taking also FNB?
Yeah, I had it last semester, but I had to redo it.
Yeah. Just make sure your Connect access is still active. I mean,
all right, I'll check that. I'll check that.
I'm gonna set up a new, because I'm gonna have to set up a new Connect course, right, on McGraw-Hill, because last semester it cannot be used again this semester. So
but the code should be good though. Because the code says
make sure your code is still
360.
valid,
360. Okay? Yeah, it says 360 days.
Huh?
It says 360 day access.
Yeah, if you have 360-day access, it should be good. Yeah, Shabir, you had you have a question, Shabir? Yeah.
Yes, Professor.
Yeah.
Yeah, actually, I just have a question about the online class. So, the other student just said like we have to go to the Fitterman building, or what?
Oh, you mean FNB 230?
No, for this class, for FNB 300.
No. This class is online. This is 100% online. You don't have to go to the Fitterman.
Okay. So, yeah. What? So just one more question about the book. So actually, I purchased the book last night, so it's gonna be like.
It's okay. But the problem is, if you just placed an order, it might take more than 2 weeks. So if that is the, what I suggest is, I mean, if you want the book ASAP, what I want to suggest is just buy an ebook, cancel that order, buy an ebook, and you can buy. I think they have like 6 months option. If you buy 6 months option, the price would be very. I don't know if it's the same price, but for Finance 100, the price was like $50 for 6 months option.
Okay.
Right?
So Professor, how about the exam? Is gonna be on the Blackboard or through the Connect?
Well, I'm not gonna. I don't know. Maybe I'll put a, because I don't know what the price is for 6 month deal. You just need to find out. You have to
Professor?
contact them. I will put. Listen, I will put the contact information of the McGraw-Hill's campus representative, so you can ask that person, right? And there is certainly the 6 month deal, and the price would be much lower. Yeah, I will take. I saw Irina's hand for a while, so I'll take Irina's question first, and I'll get to whoever is the next. Yeah, Irina, go ahead.
Hello, Professor. Thank you for the lecture today. And I have ordered the book, and the link which you provided is the ebook, online book, and it's available for 1 year. So, but
because that's not an ebook. Listen, that's not an ebook. That's a custom edition. So that's a physical book with the Connect access.
I don't see the physical book. They're not gonna send me. It is an ebook because I already have ordered it, and they didn't ask me for address. They just gave me the access for the book.
Oh, okay. That's an ebook. Then that's fine. I don't know why it is just an ebook, because that's the custom edition. So what was the price? Did you pay something like $130 or what?
I paid, I believe, 91 something.
Oh, good. That's very good. That's good. That's even better than the ebook. I think the ebook is. I mean, the regular ebook prices should be something like 130. But if you paid like $90, then you got an ebook.
Yes.
And you have 360-day access to Connect.
Yes.
That's wonderful. That's wonderful. You got,
Yes.
But
wonderful. You have to post the link to connect this book with, I don't know, your.
I corrected the link. I corrected the link in the syllabus. So if you click on
I saw it. Thank you, Professor.
On the syllabus.
Yeah, but there is no code in this book. I mean, which I bought, there is no code. They said like you should connect, like you should give us the connection to, I don't know, so some kind of problems or tasks. You're gonna give us maybe homework.
If it's an ebook, it should have the access to the access code to the Connect course. Listen, I haven't set up the Connect course. I haven't set up the Connect course yet. So once I set up the Connect course, I will provide the link, and then you can use the ebook comes basically. Ebook is a package deal. Ebook is basically so I guess they are not doing the custom print edition anymore because that one is ebook. If that one is ebook, good. But I originally devised it as a physical book plus the access code. And so someone who I think it was Shabir. If Shabir ordered the book, he must have received the access code already, ebook access code, or something. I don't know why he wasn't mentioning that. Okay, who else was next?
Thank you, Professor.
You're welcome. You're welcome. Who else was next?
Professor, actually.
Damien.
No, Professor. That answered my question as well. So
okay,
that was it. Thank you.
All
Have
right,
a good
you're
weekend,
welcome.
Professor.
All right, you're welcome. So, any more questions now? Shabir, you're still around, Shabir?
Yes, Professor.
Oh, Shabir. So you said you ordered last night?
Yes, Professor. Actually, I have the access to the book, but I was talking about the homework stuff. You know, the online
Oh yeah, yeah.
activities.
You don't for the homework, you will have to wait until, so you don't need to cancel that order. You already have the ebook. So I will, for the homework, I will first have to set up the Connect course, and then I will provide the link to that site. And so you don't have access to Connect course until then. Okay.
Okay, I got it, Professor. Thank you so
All
much.
righty. All right. All right, so that's it for today. I will see you guys next Saturday, okay? Next Saturday. And if you are taking also my FMB 230 Monday, depending on the weather, hopefully, we'll have no problem, but it will be in-person class, okay? All righty, that's it for today. So stop sharing, stop recording.